not to say we'll be able to answer every question, but we're certainly happy to hear them. Very quick introduction. So we're not here to talk about us. We're here to talk about the things that we can assist you with. Both Karen and I are rural financial counsellors with the Rural Financial Counselling Service, Victoria West. It's a hell of a mouthful. We are funded by the government to provide free, independent, confidential support to farmers who may be experiencing some financial distress or at risk of financial stress. The service is spread across Western Victoria, so very broadly from Melbourne up to Echuca and pretty much everything west of that location. There are 20 of us in total. We're pretty aware of the toll that the financial stress can have on the well-being and relationships of farmers and primary producers. So to that end, we also have a team of wellbeing counsellors that we work in conjunction with. Yeah, that's another bow in our string, so to speak. The support we provide is across a fairly broad range of financial matters. So we can provide assistance with budgets and cash flows, lender and creditor negotiation, finance application, grants applications. I'm sure a number of you may have been impacted by the floods back in October 22, so you may have already come across us as part of that. If not, well, we're certainly out there in full force. So that's now wrapped up, but we are dealing with a lot of the residual effects of that flood event. In relation to Karen and I, we both have agri-banking backgrounds before moving into the counselling service, and we still maintain a very regular contact with a lot of the relationship managers within the banks. So we try to get our finger on the pulse there just to understand what's changing, what's happening, just so that the information that we provide to our clients is current and in line with what the banks are actually looking for. So again, as I said, we're happy to answer your questions as we go along. So if you've got any, please feel free to stick them in the chat box, and we'll address those as we go. The purpose of today's webinar is fairly general, and we're looking at things like what are banks and financiers looking for in various scenarios. So we acknowledge the fact that every bank is going to be slightly different in terms of the level of comfort they have with primary producers, the level of debt they're prepared to carry, seasonality problems, all of those sorts of things. So no two banks are going to be identical, but yeah, we will keep it sort of fairly broad in that regard. What we're going to talk about today is primarily around finance applications for a new loan, looking at increasing your existing lending, and also looking at the review process that the banks are going through. That's that wonderful phone call you get each year. We'll try and explain why lenders ask for certain information and what they're actually looking to see. So it's not just a random phone call or a random email just asking you a whole bunch of information together. There's actually some reasoning behind it, and just to try and give a bit of an explanation for that. And I'm sure many of you have been through the review process numerous times over the years, and I'm sure that you've realised that over the last few years there's been a real change, probably in the last maybe 3 to 5 years, in that relationship with the banks. So unless you're at that very large end of the scale, what we're seeing very broadly across all of our areas is the interaction between the bank and the farmer is becoming less and less. It's a lot more managed remotely, which is not such a fantastic outcome for the farmer, because you lose that one-on-one contact, you lose that opportunity to sit down at the kitchen table and have those discussions. So what we're looking at today is ways that we can't solve that problem, but ways that we can try and make that work a little bit better. So as I say, if you go back a few years ago, your manager knew your business history. They had a real clear understanding of what your goals were as a farmer. And they also got to know your family, understood what the family implications were with the farming operation. Your values and your understanding of what the bank sought from you was also built over a large period of time. It wasn't just something that you met the banker and all of a sudden everybody knew everything about everybody. It just didn't work that way. So having the opportunity to build a relationship over many years was something that was valued by both the bank and by the primary producer. Since the Bank and Royal Commission back in 2018, a lot of the decisions that were previously made at the kitchen table or made by your direct manager are now being channeled back through to head office or to a centralised credit processing area. And they're looking at numbers and ratios and those sorts of issues a lot more closely than what they used to be. What we're seeing as counsellors is that a lot of the bankers that are now going out on farm are a lot younger, a lot less experienced, and they haven't been through a lot of the issues, the tough years, the droughts, the fires, all of those sorts of things that a lot of the older bankers have dealt with in the past. One of the big ones that is really showing its head now is a lot of the young bankers have only ever experienced a decreasing rate cycle. They are struggling to understand and grasp how to manage clients in an increasing interest rate cycle and how to manage that program going forward. So where do we start with this? If you, like many, have experienced a change in relationship management in the last little while, and we know for a lot of people that has actually taken place, it's really important that you engage with the manager as much and as often as you can. The issue for the banker is needing to understand where you are, why you are, where you are, how you got there, the debts that you've got, what brought those about. Was that through succession planning previously? Was that from buying the property next door? Was that inherited debt from mum and dad years and years ago? Whatever the case may be. So they're looking for some understanding that you understand your financial side of things, and then look to explain to them what is the plan for the future. Now, is there an opportunity that you're looking to expand the farm? Are you happy the way things are operating at the moment? Are you looking then to perhaps move into succession planning and look to move the farm on to the next generation? Those sorts of things. So they're all part of the discussion piece that you can have with the bankers as you're trying to develop that relationship as you go along. If the bank is on board with your short-term plan, that's wonderful. So we're talking about your next 1 to 2 years. But if you haven't got the confidence that they're going to be there for you for that longer-term period, and we're sort of talking there the 5 to 10-year period, then maybe it's worth having a look around and seeing what other lenders are out there. We're not advocating changing banks at the drop of a hat or anything like that, but you've also got to be aware that loyalty to any institution, whether it's your bank, whether it's your accountant, whoever else, can end up costing you money and inhibit your growth strategy if that's not kept a close eye on. Probably one of the other big ones there that we don't see so much anymore is not just having the relationship with your manager, but also having a relationship with their offsider. It's surprising the amount of impact or influence, if you like, that the offsider actually has on what takes place, particularly in terms of putting loan applications together and all those sorts of things. They're the one that sits behind the scenes, work a lot of the numbers, work a lot of the other sort of crossing the T's, dotting the I's, all those sorts of things. So engaging with them, inviting them onto the farm along with the manager, so it's not just the manager that comes out, but it's actually bringing out the other party as well, can actually have a positive impact. The other thing there is that if the manager is away, if the manager goes on long service leave or, heaven forbid, leaves, then there is that little bit of continuity there for the farming operation as well. You're not just left out in the lurch by yourself trying to deal with it. Probably a big one here is to spend a bit of time looking at where you've started and where you are now, but also celebrating the successes that you've had, particularly if you've come through a tough year. So in the conversation with the bank, if we're talking about a situation where you've done things tough, be prepared or be capable of looking back and just sort of acknowledging that now not every year is going to be a great year, but you do have great years, and what that growth has looked like and that success has looked like over years. Yeah, I'm just reading my notes here. I'm sorry. One of the number one features I think we can all agree on is communication as being the number one issue that we need to be on the front foot with the bank or any other creditor that you've got. Communicating with the bank very early in the process if things are starting to get difficult, particularly if it doesn't rain by a certain time or if the crops aren't sown by a certain time, making the bank aware that there may be an issue at some stage in the future and engaging with the bank very, very early on in that process. And not just sort of hoping and crossing your fingers and anything like that, but actually engaging with the bank from an early start of the process. If you identify that there is something that may crop up in the short to medium term, engaging, communicating with the bank is a really strong way to develop that relationship as you go forward. Sorry, Karen, I'm sort of lost myself here a little bit. Oh, there we go. Okay. Yeah. Sorry, yeah, there we go. I'm sorry, guys. I'm scrolling through this too quickly. Just going back to the communication piece again. So raising those issues with the bank is always a great idea. The reasoning behind that is it's not just to get you guys on the front foot as well, but also to bear in mind if you're having a tough time, then it's highly likely that your neighbours and other people around you are in a similar situation. What that's going to mean is that demand for the service from the bank manager and from the other services within the bank are going to be increased. So there's going to be additional pressure on the bank to try and address everybody's situation. So if you're the first cab off the rank, so to speak, then that puts you in a better position to have those conversations with them. Things that the bank's looking at when we're talking about annual review now. Sorry. All right. So when the banks are looking at your financial situation, they are looking at your historical performance, but it doesn't necessarily mean that a bad year means no further lending. The figures show how the farm business has performed, and you should have a look at your profit and loss for last year and see how it compares to the year before and the year before that. So building that sort of not just a 1 year standalone good year, bad year, whatever, but looking at it over a longer term. So looking at your averages and those sorts of things. Be prepared to explain the variations from year to year to the bank. So just understanding what's been the drivers behind the income, expenses, those sorts of things. So was it a bad year in terms of rain? Was fertiliser more expensive than it was last year? Just understanding what are the things that actually drives the profitability and otherwise within the business. So this sort of leads on to what I was saying before. The banks are looking at numbers and ratios and those sorts of things a lot more than what they have done in the past. But also understanding the story behind the numbers is very important. So looking at things where you have had that tough year, well, how did you manage that tough year through? What were the challenging issues that you faced? How did you deal with that? Was it a reduction in expenses? Was it a change in the program? Those sorts of things, and being able to explain that to the bank as well. So probably the key takeaway from all of that dribble that I've just given you there is that agri lenders do understand that farms face headwinds at some point during their business cycle. It's how you deal with that determines how the bank will look at any finance proposition going forward. So how did you manage the times when they were tough? A good management history can be the difference between the bank supporting you or not. And then looking at, even if your business is not in a challenging position right now or hasn't been of recent times, start thinking about how you would manage if that situation was to change. So, if I'm looking outside today, we've got a bit of rain coming down. So thankfully that may ease some of the pressures out there at the moment. But making some decisions around, well, what if we don't get that spring rain that we desperately need? How is that going to impact the farming operations? Those sorts of things. And just to highlight back to what I said a moment ago too, is that the price of commodities, the seasonal aspects, they all affect everybody fairly equally across the board. If you find yourself in a little bit of an issue, make sure you're engaging with your lenders, with your creditors in plenty of time to be able to develop a plan and a strategy to move forward from there. So what I'm going to do, I'm going to hand over to Karen now to move on with a little bit of information around some additional lending or the requirements for additional lending, and just to help a bit of understanding there.
So if we get into the nitty-gritty of what the bank needs, so for a finance application, the bank really needs to know what your current position is, and that means having your 2022-23 financial year tax completed, and also a profit and loss for 2024, and that profit and loss does not have to be in any formal accountant prepared format. If you've got Xero, MYOB, Quicken, that's great, just income and expenses, but the bank will need to know how you're tracking financially right up until pretty much the point of application. Your lender will appreciate you providing all the information to be able to make their decision without too much back and forth in between. So if you can have your 23 tax, 24 profit and loss, a realistic cash flow budget, which I'll talk a bit more about, and your statement of position, then that's going to be a big help to getting a fairly quick decision for your finance application. So the starting point with any finance application, and that's whether it's a new loan or increase to your existing loan, is to prepare a cash flow budget. So you've all got your cameras off. I can't see the eye rolling that's going on when I say cash flow budget, but I love them, and so do banks and lenders, financiers. Budgets are really good at showing where the pain points are, and it provides comfort not just to the bank but to you, that you will be able to get through those pain points and get through the next 12 to 18 months with the appropriate support. So when you approach your lender, it's important to know what you're asking for. So are you asking for a temporary overdraft limit increase that is a short term, 3 months, or a more permanent loan increase that might be over 12 to 18 months? Are you wanting your principal repayments deferred just to take a bit of pressure off cash flow? You wanting to be interest only? And I find with lenders, I think the direct approach is always the best. So as Matt said, you've thought through your business, where you want to get to, what it needs now, where are the pain points. So rather than go to the lender and just say, I'm in trouble, I need help, I think the direct approach, where you ask directly and say, we've got a cash flow shortfall in October. and we need to pay some accounts, we need to put in the next crop, we won't be able to repay until that crop's harvested in 2025. Show that it's possible in your cash flow budget, and that approach where you're directly asking for what it is you've identified the need, you know what support you're asking for the bank to get through, and then you're not just throwing a bit of a wide net and asking the bank, how can you help me? The starting point should be, this is the issue, this is what it needs to be fixed, now how can we work to make that happen? So when it comes to realistic cash flows, you do hopefully like to leave a little bit of buffer and wiggle room for unplanned contingencies, and I'll come back to that word hopefully soon. It's thinking about the what ifs. This is the budget, this is my cash flow as I see it happening, but what if something breaks down? What if a cheque doesn't come in? As old bankers speak, we still talk cheques. What if I don't get the yield or the price that I want? How am I going to be able to, how will that impact my cash flow budget? How will I be able to cover my interest payments? Is that through pausing principal or freeing up cash flow? We saw with the instant asset write-off for plant, equipment, machinery that there was a lot of machinery purchased, and the instant asset write-off was great for your tax, but now you have a 3, 5, 7 year payment on your machinery that can potentially be really hurting your cash flow. So are you freeing up cash flow by refinancing that machinery to something else? That it's always a conversation to have with your accountant, but just thinking about ways that you might be able to improve your cash flow position. It's thinking about the risks to your business and what will you do to mitigate those risks. So with your realistic cash flow budget, if you think that you should present what looks more attractive to the bank, if you provide an unrealistic cash flow, the chances are that you'll be back in 3 to 6 months asking for more funding. So it's better to just go once with your clear request, your clear plan or strategy of how you're going to repay that increase, and to just do it once and get it right is pretty much it. And I always say that hope is not a strategy, and we do say we hope it rains and we hope the crop goes well and we hope harvest is ideal weather, but hope is not a strategy. So it is important when you're talking with your lender that you use positive language and avoid saying hopefully. Say it's intended that we will, or I plan to, the business will. It's a bit more assertive, and that you're a business manager running your business. Yes, there's all sorts of outside influences when it comes to weather and price that will impact how your business operates, but just with knowing what you know today and what you can plan for. I hate to use the word normal year because we don't know what a normal year is, but that is what that's what the bank would be hoping to see, and I would hope that you would have confidence in your request to the bank. So the ATO portal snapshot is another important thing that most lenders will ask for, to know if you are up to date with your tax. So whether you are asking for a loan increase from your existing financier or you're talking to other lenders, everything that you needed in the previous slide, plus your 3 years historical financials and income tax returns, the bank is looking to see how you've travelled and how you've managed previous good and not so good years, and your 12 months of bank statements that will also help you to help the lender to understand how you manage your business. And it's not always going to be bad that there might be some dishonours or return payments on your most recent statements, but it is important to communicate with the lender around why those the red flags are on your account.
All right. Thanks, Karen. So we'll move on now to the annual review process. The information that lenders chase as part of the annual review are very, very similar to what Karen just described there with the new lending and the new financier. But where it differs is the conversation that you have with the bank at the kitchen table each year. And hopefully it is at the kitchen table and it's not done over the phone. It's looking at what have you done in the last 12 months? How have things gone? Have you achieved the things that you set out to achieve? If you haven't, what's happened? If you've had a great year, well, what's happened there? Now, how did that come about? They're looking at things like where has the previous year's surplus gone? So if you've had a good year previously and you're now asking for perhaps an increase in your overdraft, what's taken place with that money? Has that been a case that there's been investment in infrastructure on the farm? Has there been a new shearing shed installed? Have you made an off-farm investment? The kids now going off to boarding school? Those sorts of things. So just having an understanding of where the money comes from, where the money goes to. They're also going to be really, really interested in looking at what are you going to do next season. So this is a part where you have a huge amount of input in how the bank takes a view on your farming operation. So looking at if you're a cropper, for example, what is your cropping program going to look like? So areas sown, what are you sowing? What are your target yields? Those sorts of things. And then looking at what are the expenses that are going to be incurred on the back of that. If you're a livestock producer, then again, looking at what are your joining percentages, what are your lambing rates, when are you looking to sell, shear, those sorts of things as well. It's also the time you have that conversation with the bank around things that you want to change within the farm. So you may have this idea that this year we want to build some containment yards, for example. So that's the opportunity to build that into the budget, to look at, well, what sort of capital expenditure, what sort of cost is going to be incurred in doing that? What's the impact going to be in terms of the cash flow, both from a positive and a negative sense? So improving the condition of the years prior to joining. So we're going to get better lambing percentage, therefore better income, those sorts of things. But we're going to have an increased feed cost, for example. So just showing that you understand what's actually transpiring within your farming operation. Also, how long is that impact going to be? So is that going to be a short-term one? Is it going to be a long-term one where you may not see the benefit for that capital expenditure today? It might be something that comes to fruition in 18 months or 2 years' time down the track. It's then you can have that conversation with the banker on how do you actually finance that? Is it something that's going to be financed over a short 5-year term, or is it something that's going to be financed out over a longer period of time? Is it a form of asset finance if you're looking at updating machinery, tractors, headers, sprayers, all those sorts of things? The other really important one too is also to look at what I call the appropriateness of the finance that you've got. One thing I do see occasionally is where each year the bankers come out, they've sat down and there's been a discussion like, oh yeah, listen, we need another 50 grand this year or another 100 grand this year to get through the cycle. And what ends up happening is that you end up with an overdraft that's far in excess of what's required for the average or standard running of the farming operation. And a relatively small term loan, which might be against a piece of dirt that you bought some time ago. So this is the opportunity to review that sort of thing. And the reason I raise that is because as a general rule of thumb, you're paying anywhere between 1% to 2% more to run an overdraft than you do if you're running a term loan. So there are some cost savings to be gained there as part of that conversation that you're going to have with the bank. The other thing to look at too is, even though it's called the annual review, and it is something that's formalised and the bank must do it and all those sorts of things, there's nothing to stop you asking the bank to come out once every 3 months or once every 6 months or whatever the case may be, to sit down and review exactly what's been going on in that period of time since your last quarter, updating your cash flows, looking at are there any pain points now that are, as the season's progressed, having the opportunity to identify those and deal with those, or conversely, are you perhaps looking at a tax position where you might actually be better off going to speak to your accountant and making some decisions around tax management strategies prior to the end of the financial year. So it's just to keep those in the back of your mind that even though it's an annual review and it is something that you have to do once a year, some people actually choose to do it far more often than once a year, and there are benefits to be gained from that. We've sort of covered off briefly around the cash flow and how that is required if you're looking at refinancing, if you're looking at borrowing more money, those sorts of things. But again, just on a standard year-to-year basis, putting together a cash flow that you understand, that's the key part to it. It's your cash flow. You need to understand it. But looking, when it comes to building a cash flow, looking at the things that drive the business. So again, looking back at a cropping operation. So what are you sowing? What are the yields? When do you sell? Do you hold some over and sell it later on in the year? Those sorts of things, because that's going to influence the cash flow through the business cycle. And then looking at what are the expenses that are incurred with that. Also understanding what drives the assumptions that you make there. So it's no good saying, well, I'm going to sow down 500 acres of oats this year, but I'm going to achieve an 8 yield. Maybe, maybe not. If that's a realistic statement, then provide the assumptions behind that so that the banker can pick it up and go, well, yeah, it is outside of what we'd consider the ordinary. However, in this particular case, this is why they believe they're going to get to that sort of point in the future. Again, looking at the cash flow, just identifying those, as I say, those pain points. So those periods of time when there might be a bit of pressure on the cash flow, and just understanding when that might correct itself. So whether it's going to be just I've shared the merinos, but there's not actually time to sell the wool. We're going to hold it over for another 2 months. However, we did have that in the cash flow for next month, so maybe we need to get a bit of temporary accommodation for a short period of time. Just something to bear in mind also, going back again, we'll talk about the appropriateness of how your debt is structured, that if you are borrowing money for working capital means, making sure that you've built in a methodology within your cash flow so you can actually pay that back, so you don't end up carrying effectively a hardcore debt for something that's been used for just the day-to-day running of the farming operation. Yeah, probably the big one there is that you're not relying on the increase in your equity or the improvement in your equity as a way to sort of offset that ongoing debt. You also want to be keeping in mind some way or form of how to actually reduce that debt over time. Just a real quick point on equity. It's certainly a conversation that you have with the bank. The banks are certainly very interested to understand what your equity position is, but just bear in mind that equity does not pay the bills. It's just one measure behind the viability of a farming operation or otherwise. Some people have an idea that I've got this fantastic equity, but if the farm's actually not paying its own way, then the equity itself as a standalone feature is not going to be enough for a bank to say, well, that's a great idea. Let's lend some more money into this business operation. Right. So we're just going to move on to new lending now, and I'll hand you back to Karen.
So equity is in there, but I'd say that the number one thing that lenders are looking for with a finance request is serviceability, which is, can you pay your loan interest and your operating accounts? If you can't meet your at a minimum interest commitments and operating accounts, then the bank is likely to decline the lending request. So it's one thing to be able to potentially pay the loan interest on your increased finance, but then is there a plan to repay that? So principal repayment capacity is probably next after serviceability for what a lender would be looking at. And ideally, you would like to have more investment into your farm or more ownership of your farm and property than the bank does. Ideally, if the bank has got more than 50%, the equity, then it's not that they're running the show, but you're a bit behind the eight ball for trying to potentially build equity. So principal repayment is a very good way for you to start taking back more ownership of the farm equity than the bank does. So it's important to have a plan around the repayment, whether the reason for your request is to just get through a tight time, or it's for an investment that is going to increase your income, or will the repayment be through some deferred income or an asset sale that's coming down the track? So serviceability is key. The ability to repay the loan increase is highly regarded. And then equity is probably behind those two. So equity in the property is the lender's ultimate repayment option, is that at some point in the future, if the property was sold, the lender will recoup the lending funds. But no lender provides finance expecting you to default on the loan and wanting to sell your farm. That's not how lenders approach lending, and it shouldn't be how you and your business approach it either. We'll talk about the lender hardship teams a bit more later, for if you are having financial hardship and difficulty. Lenders will always ask you to provide an updated statement of position, or sometimes called an assets and liabilities. And that's not your balance sheet. Your accountant will prepare a balance sheet, and the values used there by your accountant are for tax purposes and not always the market value, especially around livestock value and property value. It can often be the purchase price and not what they're worth in today's market. So when the bank wants to see your current position, it's if you had to sell everything today. It's not what you hope to get for your proceeds down the track, but it can be factored in that there is an anticipated upside to your position if the produce on hand comes to its full value in the future. So the financiers will want to see that your loan increase can be paid back with scheduled principal repayments, and you should be able to show that in your budget for this year and your budget looking forward to next year. And then what we call the year-on-year position is that in a normal year, as much as you can predict normal, is the business likely to be able to pay this increase back within a certain time frame. So it's important when you're looking at that cash flow budget and lining up when you can make some principal repayment to pay back that increase, is that your principal repayments line up with when the income is banked, because the inappropriate timing of the repayments can put further stress on your cash flows. So just allow for that repayment being a month after you expect the income to come in, and there's not frantic phone calls for a few weeks with your manager about being over your overdraft limit, funds coming in and that sort of thing. So with the lending, we've sort of talked about what is good to see when it comes to cash flow budgets and projections and your financial history. What really scares lenders is something that needs to address, and the number one issue for lenders is if there's ATO debt and if your BAS is not up to date. So before you consider talking to the bank about a loan increase or new finance, getting your ducks lined up in a row with your historical financials, getting your tax done, having your most recent profit and loss, is also making sure that your tax is up to date and your BAS is up to date. And if there is an ATO debt for personal income tax or GST, then have you set up a payment plan with the ATO, and has it been accepted? And is that payment plan in your cash flow budget? So tax is not always a bad thing. It generally means that the business has been making money and you've been making money. But it is important to address, when you look at a cash flow budget, to factor in that you could have a lingering tax debt. the banks, that would be the debt that frightens banks the most, and just causes them to pause and take a step back and probably have a really good look at how you're going. And sometimes it could be a matter of your accountant had health issues and was absent for a time, and things got a bit behind, or is there something a bit more underlying about the business and how it's operating with tax not being done. And the other thing that scares lenders is creditor action. If there's some legal action being taken, if debt collectors have been knocking on your door or sending through some emails. So it is important to be upfront on your assets and liabilities, that you do declare your creditor position for what is 90 plus days overdue outside terms, and what and which accounts, which suppliers are you getting the most pressure from regarding payment. And the lenders will ask for your last 12 months of bank statements, your trading account statements, if it's new lending, or even if it's with your existing lender. If they're seeing a lot of dishonours and reversals on your statements, then that's a red flag that does concern lenders. But sometimes there can be a very good reason around that, whether it's floods, droughts, issues. The lenders are probably looking at what was within your control and what was outside your control. And like Matt said before, if it's outside your control and it's climate related, it's probably every farm in the district has had some impact too. Part of those red flags and what the bank is concerned about with rising ATO debt or creditor debt is, how long does the bank keep funding an operation that has steadily declined over a number of consecutive years, even during the good years that there's been challenges financially. And sometimes it's the right thing for the bank to say no more debt if the business hasn't been viable and is not likely to be viable without some definite strategy in place, and whether that's to diversify the business or reduce the scale or sell assets or properties to reduce debt or bring in off-farm income. There needs to be a strategy to address. So sometimes a lender saying no is the right thing to do, but we do want to make sure that we don't finish this on a negative note. All the major lenders have hardship teams for clients experiencing financial hardship. Rural Financial Counselling Service can support you to engage with hardship teams for relief. Generally, engagement with a hardship team does buy you time to potentially work with a rural financial counsellor to just take a step back and have someone such as us come into a business, particularly something that's second, third or fourth generation. And we do understand that there are incredible emotional ties to properties and farming, but we can be a bit more of an outside look, but independent too. We don't work for the banks. We don't work for the creditors. We're there to support you. We're more than happy to come in and support you. We'll put our contact details up soon. I'm just going to share. This is just a bit of a summary of how you can be proactive with discussions with your financier, and especially around increasing lending. Is communication early is the key to articulate what the support is that you're requesting, the loan limit increase, how much, whether it's relief from principal repayments. Throw it out there, just ask if they can sharpen the pencil a bit on your interest rate. You never know. It's always worth an ask. Have a plan and strategy is to not go in with hope, but really think about what are your options to get through this tight time, and then for the business to recover financially. And always address your creditor position. before you talk to the bank, or at the same time, be discussing payment plans and negotiating payment plans with your creditors, with the ATO, and factor that in when you are thinking about how much you can or how quickly you can repay your loan increase. So just to finish off, we encourage you to contact Rural Financial Counselling Service if you're experiencing financial stress, if you're at risk of financial stress. When you contact our 1300 number, that is our Hamilton office, and our admin team will get your contact details generally within 24 hours. A rural financial counsellor will call you. So the sooner you start looking at your business and considering what you might need in the future, it's always a good time to speak to Rural Financial Counselling Service. So that's where we've just about finished. If there are any questions, we'd love to hear from you.
We have got a question in the chat box. Yeah. In general, are RIC loans cheaper than bank loans?
Quick answer is yes. The rate on the RIC loans as of about a fortnight ago increased to 5.18. That rate's not fixed. It is reviewed every 6 months, both in February and August. So they've just had the review done a couple of weeks ago. But notwithstanding, that rate's, from what we're seeing, is certainly significantly lower than what the commercial banks are charging at the moment. When we are in a low interest rate environment like we were 2.5, 3 years ago, the difference between the two was perhaps not so great. But yes, certainly the gap between the rates now is substantially more. And when you're looking at a maximum RIC loan of $2 million, if there's a 2% differential sitting on the back of that, that's a $40,000 interest saving per year. So it can be very, very significant.
And there are some farmers who we do recognise that it can be a clunky process to potentially refinance. So I have recently used RIC loan as a bit of leverage to have an existing lender just reduce the rate, and they reduced it by nearly 1% to get a bit closer to the RIC loan rate, which is currently 5.19%. So I went out, met with the farming family. We talked about RIC loans. They also had a meeting with their account manager the next day and deliberately left the RIC loan application form and brochure on the table as a bit of leverage to ask their bank for a rate cut, along the lines of, if you can get down to 5.8%, we'll stay. We won't take our $2 million elsewhere. So that worked. It doesn't work in every case, but certainly I wouldn't say use it to bluff that this farming family would definitely have refinanced if the bank didn't come down. They were looking at going to RIC for $2 million.
Any more questions, please? Yeah, put it in the chat box. I'm just having a quick read. I've got one question. So in the good times, I suppose very recently the focus has been on tax avoidance and a lot of purchasing of equipment, which you touched on. What other options can we consider other than building, I suppose, our assets when we have got that increased cash flow?
One of the, so it's necessarily all that popular, but one that's certainly out there is the farm management deposit. So that's a form of term deposit that's placed down with the bank for a 12-month period, or a minimum of a 12-month period, and that whatever is placed into that farm management deposit is effectively deferred income into a subsequent income year. At some point, that lump of money will come back into the cash flow cycle, but ideally that's going to be when things are a little bit tighter, and it won't incur the same sort of tax imposition that it might have done on the year in question. So if you're looking at a substantial or potential tax liability, that is one method that can be used to defer that income into later financial years. I will qualify everything that we say is not advice. I'll be really clear on that. It's really just trying to provide some information for things that are out there and available to everybody in terms of a primary production.
I think we've nearly rounded up. There's been no more questions put in the chat box. So thank you very much, Karen and Matt, for your information today. I have put in the chat box an evaluation link. Also, Karen has put the Rural Financial Counselling link there as well. Thank you all for joining us today, and we will be in touch with future webinars and events coming up. So thank you all, and enjoy the rest of your afternoon.